When someone talks about a diversified portfolio, they're generally saying, hey, I have a mix of stocks, bonds, ETFs. But the problem is everything in that portfolio is market based. So I want to ask the question to those listening, particularly the high income earners that are putting a lot of money away. Do you own stocks? And this could be your own brokerage account, could be mutual funds, could be ETFs. Do you own bonds? And these could be all kinds of bonds, corporate bonds, treasury bonds, savings bonds, whatever that looks like. Is your market-based portfolio underperforming, or do you believe it could underperform? These are questions that we want people to consider because we all know market-based investments are volatile. And I love sharing this PE ratio, basically price to earnings ratio. We've only hit the peak, Steve, 3 times. Once was during the Great Depression, once was the dot-com bubble, and the third time it's happening right now, the AI bubble. We don't know what's going to happen. But what this is telling us is that stocks are overvalued. So if someone's saying, hey, I'm not sure what's going to happen in my market-based account, we're saying perhaps you want to think about diversification in a different way. And true diversification is not a mix of stocks and bonds. True diversification is having different asset classes. And what we want to talk about today is a different category of asset. And I'll bring up this chart. You could have cash, you could have stocks, bonds, gold, silver, business, retirement accounts, IRAs, 401ks, TSP, 403b, etc. Real estate. The class we want to talk about today is high cash value whole life insurance as a different asset class. And the reason for this, cash value whole life insurance brings things to the table that the stocks and bonds don't. We'll get into that in a minute, but I really want to emphasize that true diversification is not all market-based. You might be talking to your financial advisor that says, hey, you need more diversification, so he sells you some different mutual funds. You're still in the market. That's not a different asset class. That isn't true diversification. True diversification is a mix of different asset classes.
Well, what would you say about the whole bonds thing then? So you got, I mean, is that technically, is that a different asset class, stocks, bonds? And what's the thought on that?
Yeah, they are different asset classes. You could be a person that owns stocks and no bonds. You could be a person that owns bonds and no stocks. They are different asset classes. Generally, when interest rates rise, bonds lose value. Whole life dividends, they move the other way. So we want people to see that having true diversification is not just having all of your money in the market. And Steve, I run into this week in and week out. People coming to me saying, hey, I'm planning for retirement, or I'm looking at retirement 20, 30, 40 years from now. I'm planning on Social Security and my 401k. That's it. And I'm saying to them, if that's all you have, if all of your assets are in the stock market, one, you're not truly diversified, but two, you're not going to know what you'll have in the future. With whole life insurance, the dividends and the guarantees, there's some predictability there, there's certainty there. We want people really to see, how can I have true diversification, not just all market-based?
So you got traits that were within this asset class that are not found in any of the market base, and that is a better barometer of diversification because it's totally different, right? It offers things that the market-based investments don't.
Yeah, and I love, you've commented many times, it's an uncorrelated asset.
Right. Thus, another, or that's the way that we describe that difference, right? That it's not correlated, and therefore, because it's not correlated because of the contract, right? Because of the contractual nature of it. I talked about that. market-based, you're subject to the market. When you wrap it in a contract, and people will say, well, there's bonds, life insurance companies invest in bonds and these kinds of things. But the fact of the matter is that when you wrap it in a contract and you remove the risk for the person, the consumer, then you've got a completely different level of protection around it.
Yeah, and great segue. This is one of our top mutual insurance companies' portfolio, right? So these mutual companies that we use for properly structured high cash value whole life insurance, they have a portfolio. They're investing money. Well, notice here, 73.5% of their portfolio is invested in these investment grade bonds. You've got 4% below investment grade bonds, 2.6 short-term in treasuries, 9.2% other assets. They've got less than 1% of common and preferred stock, 6% policy loans, and then some venture capital. I'm pointing this out because most mutual insurance companies like this one here, their portfolio is made up of primarily these investment grade bonds. And the great thing about having whole life insurance is you're letting the insurance company buy the bonds for you. They're the professionals. You're not taking risk. They're giving you a contractual guarantee that you talked about, plus their portfolio is going to generate returns, generate a profit, and those profits come back to us in the form of a dividend. So why not let a professional, an insurance company that's been around for 120, 170 plus years, manage these bonds for you? And they're buying bonds differently than you and I individually. They're buying bonds in the multi-million-dollar tranches, and they'll hold these bonds 15 plus, 20 plus years. Let them take the risk and give us a guarantee on the back end.
Yeah, I mean, you're basically like that contract wrapping gives you the protection and lets you delegate the risk to the insurance company. They keep it. We've talked about that in regards to different kinds of policies. Specifically for the mutual whole life contract, they maintain a lot of risk because they're giving you a guarantee. Other kinds of policies, you're going to have a lot more risk delegated back or shifted back to the consumer.
Yeah, whole life, on the other hand, we're transferring all of the risk to the insurance company. I've created a quick illustration here, and we're showing just the dividend. This is all I'm going to get into today. We have plenty other videos where we talk about cash value and death benefit and policy loans and tax-free income. Today, I just want to focus on the dividend. And this is $100,000 a year going into a policy. This is properly structured. Most of the premiums going straight to cash value. Well, look at these dividends. The dividend from an insurance company, once paid, is locked in. It can never be taken from you. So if you have a bond or a bond portfolio right now and you need cash and that bond portfolio is down and you take money out of the bond portfolio or sell the bonds altogether, you're going to lose value. Here, you've got a contractual guarantee that once that dividend is paid, it's locked in. It will never be taken from you. And now that dividend is earning compound interest over time, because dividends and guaranteed returns in a whole life contract are paid on total cash value. That dividend gets added to total cash value. Therefore, you have more money in your cash value. You're earning a larger volume of guaranteed rate of a return and a larger volume of a dividend. So I like the fact that you're shifting the risk. 100%, you're shifting the risk. You make your premium payment, you get all these guarantees along the way. Now, I will say dividends are not guaranteed, but once a dividend is paid, it's locked in. And let the professionals buy the bonds for you. It's a powerful strategy because you're letting the professional insurance company, the mutual insurance company, take the risk.
Right. I don't know why I thought of that phrase. It's a bold strategy, Cotton. Maybe it's a bold strategy keeping all of your assets market-based, right? When you make the shift, you create some true diversification, you delegate that risk back to the insurance company, and then you've achieved something that has true guarantees that are not correlated. So hopefully this is resonating with you guys listening. And I love looking at those numbers, Barry, that you're sharing. You can see the dividends. Those dividends have been being paid. I think it's correct to say they're not guaranteed, but they have been being paid in many cases for over 100 years.
Yeah.
So, and companies are competitive about it. If somebody doesn't pay dividends, that's going to make its way into the marketplace. You can bank on those dividends pretty with some confidence. Let's put it that way.
That's right. Some of these companies, the company we were just looking at, they've never missed a single year of paying a dividend in over 175 years. Their track record is 100%. We're going to talk quickly about 5 benefits of properly structured whole life insurance. But everyone listening, remove from your mind for a minute whole life. And if you got these benefits in your portfolio, how powerful would it be? So it is whole life insurance, but take that out of your mind for a minute. What if you could get guarantees and dividends in an investment or an asset? What if you had access to the cash and you weren't locking your money up until you're 59 and a half, like a qualified account does, a 401k or IRA? What if you had tax-free use of the money? Steve, a lot of bonds are taxable. You could get a bill at the end of the year, whether you sell the bond or not, and pay tax on the gains of the bond. Here with cash value insurance, if you follow what we teach you how to use all the money 100% tax-free. What if you had a permanent death benefit? Or what if I said this was legacy and estate planning? If you had these benefits and you didn't know this were whole life insurance, you would say, I want these benefits. These are remarkable benefits. Well, guess what? In the 25 years I've been in the industry, the only product I've ever seen in the investment world, the asset class world, the business world, the only product I've ever seen with all these in one place is cash value whole life insurance.
Yeah, we talk a lot about that with regard to the ultimate asset. Sounds like a grandiose term, right? But the reason that we coined it is because of the bundle of benefits that all exist together in this. So making this a truly unique contractual asset in so many respects, some of which you're touching on here, right? So yeah, it's a powerful. So we're kind of going beyond true diversification in some ways, and talking about protection leverage on top of even just diversifying. So.
Yeah, that's right. And you as an estate attorney know that. Steve, our question that we want to put out there to those listening, especially the high income earners, those that are heavily invested in the market or heavily invested in bonds, consider owning bonds through cash value whole life insurance. Consider having a policy in your own portfolio on your life, or your business could own the policy, but it's still on your life. Consider this. For all the reasons we've talked about, and even others we haven't talked about today, consider owning bonds through cash value insurance. Let the insurance company buy the bonds for you. Let them take the risk, and on the back end, let them give you a guarantee and more peace of mind. And as always, our invitation, look at your own numbers.
Yeah, look at your own numbers. And I like how we came full circle on the bonds question, because whenever you mention diversification, I think for a lot of people, bonds flashes up. So this is a variation on the bond strategy. There might be people that didn't know that whole life insurance companies invest in corporate bonds. They've given a lot of attention to it. And again, we're shifting the risk. So I think those are great points, Barry. There'll be a link wherever you're watching. If you want to look at your own numbers, if this example resonates, go ahead and let us know. Leave a comment, all that good stuff. I want you to become a part of the community. With that, I thank you for joining us. Barry, thank you once again for the examples, and we'll see you all in the next video.